So in my original book, the idea is, well, once we get you profitable, well, what do you do with the cash flow that comes out of the business? And really, as we started studying the best of the best entrepreneurs, there was a natural rhythm in terms of their decision-making process. And in my original book, I called it the 4 forces of cash flow. I've since expanded it to take one of the forces that I talked about, that I combined 2 actions in one. And I really decided to separate that out and make it a little bit clearer. So actually I'm referring it now to as the 5 forces of cash flow. And so the first thing that you want to make a decision about once I'm profitable is reinvestment back in the business. Now, I'll give you a data point, hold it as a placeholder, because we'll do a different presentation talking about return on invested capital. But I will tell you this, for the clients that we work with, when I reinvest money back into the business, that is a discretionary choice. The market's not making me do it. I'm doing it by choice. Our view is the minimum return on invested capital of that investment should be 50%. So if I reinvest in some operational software and hire a developer to write our own operational program, and it costs us $200,000, I'm going to see a $100,000 increase in profitability within 12 to 24 months from that investment. That's what a 50% return on invested capital idea means in that process. And I know that may sound crazy high, but let me give you an example. So there is an entrepreneur that I'm familiar with that has some auto service locations. And so I was doing a presentation one time, and I used his business as an example. And I said, hey Fred, I understand you're looking at opening a new location. Let me see how close I get to really demonstrate this idea of 50% return. And I said, so when you look at opening a new location, you're going to spend about $1 million for the dirt plus the metal building that the service center will go up on top of it. And he said, yeah, that's about right. I said, so that means the bank will finance 80% of that. So you got 20% invested out of your own money. So that's $200,000. I said, now, my presumption is you probably have about $200,000 of opening cost and operating losses until the store breaks even. And he smiled and he said, yeah, that's pretty spot on. So that means you've got $400,000 now that is invested in that business. And so your minimum go, no-go decision for that reinvestment into the business is that, can that location make $200,000 of operating profit as a run rate within 12 to 24 months? Now the first 12 months it will make 200, but by that 12th to 18th month really is kind of the sweet spot of where I want to be. Is it going to be at a run rate that 12 months of that performance is going to get me to that 200,000? And he smiled and he says, well, what you just told me in 2 minutes took me 30 years to figure out. Because that's really the idea, is as long as the market is saying yes to what I do, what I sell, what I make, I want to keep reinvesting it back into the marketplace, because our data says 50 to 100% return is what's common from my own reinvestment back into a privately held business. Not to be confused with investing in a public company, but this is what private company data really works at. And so from that standpoint, who wouldn't reinvest? And think of your business as a 50 to 100% CD. I mean, if I'm making 50% interest in the CD, wouldn't I continue to roll the interest back in it, pay the taxes and take that piece out, but then roll the after-tax piece back in and keep going? Well, that's our belief in the way business works. And so that's why I really want reinvestment back into the business to be the first thing. Because the way, at least the US tax code, and really from what we've seen even internationally, a good bit of what we think about reinvesting back into the business is really considered an expense of the business. Now, we like to account for it below the net operating income line because it's not part of current operations, but it really is a very tax efficient way to grow the business. But not to do it to save taxes, because if you've got a 40% tax rate, to spend $1 to save 40 cents in tax, not a very bright idea. But the idea is to spend $1, 40% of it is going to go to tax reduction, and then I'm going to grow it into greater profitability. That's a good deal. in that process. So that's always your first choice of profitability. Secondly, from there is we said once we know that number, now we know the tax implications of what you're playing with, now we can set aside the tax money. Good many of the businesses are cash basis for tax purposes, so it's relatively easy to model that out to where I know both accrual and cash basis. And so the key is making sure that you want the cash out of your hands, but not sent to the taxing authority until the last possible moment. But don't confuse the taxing authority's money with your money and accidentally make a bad decision with it. So we like to segregate that, set it aside. But as I said, we only want to send it to the taxing authority at the last possible minute to not incur a penalty upon payment. So there's various rules, and you don't need to worry about what those rules are. A good tax professional, should be able to manage that very effectively. So now that I know my taxes, now the next thing I want to knock out is debt. Now I look at debt in two categories. So I've got line of credit debt that I want to get rid of as quickly as possible. Because essentially line of credit debt is a placeholder for where the bank has allowed me to reach out in the future and cash a receivable or convert inventory to cash, so to speak, and have that cash now, and then as soon as either that inventory turns over or the receivable gets paid, I then have the cash to repay the line of credit. That's technically the way the line of credit is supposed to work. Unfortunately, I know you entrepreneurs, and you like to use lines of credit like crack cocaine. And so what you end up doing is when you have a bad month, you draw on the line of credit instead of fixing the underlying problem. And so I'm not against lines of credit. I just want you to use it in the way that they were intended. When I'm having rapid growth, I want to use it to be able to cash those receivables and fund my growth, but not to a point that's beyond reasonably safe zones of coverage. So generally a good idea would be not to go ever beyond 50% of accounts receivable. Now if you may have to go above it in a dire circumstance, but realistically I want to be careful to not just go to the edge of my lending limits, because you put the business under stress and you can easily get caught in a short-term economic situation that would certainly damage the business, if not put you out of business completely. When it comes to inventory, large businesses might get some inventory financing. What we're finding is smaller businesses, banks are really only giving you inventory financing because you've got some other asset that they're attaching it to. So generally you're going to have to fund your own inventory yourself. So really we want you to do this working capital funding from your own capital. I get it that I may have to use a line of credit temporarily because it's a placeholder for future capital needs that I've got to replace with after-tax profits. Now, when it comes to term debt, totally different. As long as your term debt is being supported by a working asset, like a building, a vehicle, a piece of equipment, or whatever I need to run my business, I'm perfectly fine with that. And so from that standpoint, as long as the debt is over the practical, useful life of that underlying asset, and it was an asset that was actually needed, think of it like this. It's almost like creating a self-leasing environment. So I've got the asset here, I've got the loan. As the asset is decreasing in value, the loan is decreasing in value, and essentially, even though it's not generally accepted accounting principles, you can almost treat that loan payment as if it's a lease payment, as it's an expense of the business. And really, from a functional accounting standpoint, that's probably not even a bad way to do it. We even have some clients that do it that way for simplicity. And then if we ever need to do GAAP basis financials for other purposes, we just do the necessary adjustments to flip them back. And so from that standpoint, it's a way to really use functional accounting instead of GAAP based or international financial reporting standards basis financial presentations. So once I've taken care of debt, I'm okay with the term debt. I want line of credit to be zero. Then I start reserving cash. Well, the question is, how much cash is enough? Well, when I studied my original data set, my question that I asked of the data was, what's the deepest negative cash flow cycle any business faces in a 4-year period? So I looked back at that 4-year data across all these companies, and I really didn't see a negative cash flow cycle that was deeper than 2 months of operating expenses. And so really that's where I came up with the 2 months of core capital target. And so here, when we say core capital is defined as cash minus line of credit. Because what your receivables are, they are what they are. What your payables, they are what they are. Your inventory, if you have it, it is what it is. I want you to be focused on cash minus line of credit. And if that number is not worth at least 2 months worth of my operating expenses meaning anything that you don't get terms on. So I generally get terms on my cost of goods sold, so I wouldn't include that. But I don't get terms on my labor. So if you figured out how to get terms on your labor, let me know, because I've not figured out how to do that. So I've always got to pay my labor, both direct and management, and then I got to pay my operating expenses. I generally don't get terms on those. So generally, every cost below cost of goods sold is going to be your operating expenses for that month. You take a month's worth times 2, that's how much cash you should have in the business. The idea is once you have a peg of how much cash you should have, you now have a clear target for these other decisions. So once I'm fully capitalized, then when I have cash over and above that target, maybe now I rethink reinvesting back in the business in a more aggressive way. I take bigger risks, but it may not work. But if I lose it, the world hadn't ended. But I also then would look at harvesting that after-tax profit now, because the taxes have been paid, my business is fully capitalized, I have no debt in the business, and now I have the best of both worlds. I have a really valuable business that's cash flow generating. And trust me, there's a lot more of those out there than most people think. And so once you get the structure correct, now I can understand my business truly as an asset, truly as an investment that is cash flow generating as well as building wealth and increasing in value every day. So from that standpoint, that's the sequence of now the 5 forces of cash flow. Now, the one word of caution I will say is be careful of this. The moment that you have an obligation, a personal obligation outside of the business that requires you to take profits out of the business to fund, as I always say, you're on the slippery road to entrepreneurial hell. Because the business is not always going to be profitable. And as you can see, before that distribution in sequence, I've got to reinvest in the business, I've got to pay taxes, I've got to reduce debt, and then I've got to save money from my core capital. So I've got 4 obligations before I really get to take money out of the business. And so to go set up a requirement that the business needs to send me a dividend of $50,000 a month or $10,000 a month, whatever the number is, I put the business on dangerous ground. Because I can tell you that probably from a salary standpoint, I'd say 90-95% of the time you're going to get your salary every year, even in tough business conditions. And only the rarest of circumstances do you not. But when it comes to distribution of profit, I would say easily 1 to 2 years out of 5, you can't distribute as much as you could in those other good years. And so when you get sloppy and you start, obligating the business for things that are not relative inside the business, be careful of that, because that's really where we've seen a lot of people take a really good business and overstress it and then end up doing damage to it in the long run.